Here today we'll be looking at harmonic patterns, and harmonic patterns are correlative structures in price charts that provide near accurate predictive analysis of price actions. Okay, and I find it very useful. And this tool works with a combination of market geometry and Fibonacci retracement tool to identify price reversal zones. Okay, price reversal zones which offer high probability trades to the forex trader. And historically, harmonic patterns are observed to have up to 90% accuracy level, okay, in successful trading opportunities. So it's something that you can, it's a new set of strategy you can elect to add to what you already have. Try it out, back test it over a period of time. If you find it useful, then you can begin to adopt it in your trading plan. I find it very useful, and that's why I'm doing this video to you. We have different types of these patterns. You know, they are repetitive, they happen almost every day on different time frames. And most of the times, I recommend that you look out for them in trending markets. Look out for them in trending markets when the market is trending upwards, maybe an uptrend, or in a downtrend market. When you find it in a different market environment, it may not work, because what it actually identifies for you, it points for you the turning points, price reversal zones, a level where the price will get to, and then it will reverse and give you opportunity to trade, okay, in direction of the trend. All right, like I said, they are corrective structures. Okay, you know, in the market we have this price making impulse and then corrections. So at that structure where the price is making a correction is where we can identify harmonic patterns, combination of market geometry and the use of Fibonacci retracement tool. Together we'll have these figures and then an algorithm that will follow and then identify areas that the price will get to and then reverse. So that point is where your entry zone is located. All right, we'll be looking at the various types of these harmonic patterns. Identified some of them here. Okay, we may have many other types, but we're looking at just these 5 types. So we have the Gatling, we have the ABCD pattern, the bat pattern, butterfly pattern, the crab pattern. Of course, we have the Cepher and different other patterns, but knowledge of these 5 will help you improve on your trading skill. All right, so let's look at the Gatling pattern, a little bit of knowledge, background information on Gatling pattern. The Gatling pattern is based on major turning points or fractals in the markets. This pattern plays a trend reversal exhaustion and can be applied to the time frame or any time frame of your choice. The other key that makes this pattern unique are the crucial Fibonacci retracement that come together, you know, to fulfill a plan. All right, now let's go into this bullish Gatling, and then we have the bearish Gatling. Each of the Gatling patterns have 2 types, the bullish Gatling and now the bearish Gatling. All right, remember the bullish Gatling will form in the bullish market, while the bearish Gatling is expected to form when the market is making a kind of correction. Okay, so if the market is making this kind of move, it moves up, down, up, down. This is an impulse, and this is a correction. This is an impulse, and this here is a correction. So it is in this corrective phase that you can locate the patterns, the harmonic patterns. And of course, in this impulsive price action, we have 3 waves forming. This is 1, 2, 3, 4, 5. Sorry, 5 waves forming here, and then in the correction you have 3, 1, 2, and 3. So we can identify a harmonic pattern here. So this point and then this point. So here is the X. This is seen as the impulse from here to this place, which is the A. Okay, and now here is the B. Okay, here is your C, and then this point is your D. Always in the labeling of the patterns, The D is actually the entry zones. That's where we look at the price reversal zones, where we look at for the next impulse. And this is what every trader would like to do, where every trader would like to be in the market, at this point. So let me go back to the slide. You can see this slide here. So this is a Gartley. So there's an impulsive price action from X to A. Remember this, you locate this in a trending market. So the bullish Gartley is located on a bullish trend. So this is an impulse in the direction of the trend. Price moves from X to A and retraces by 61.8%. I go back to this place. Price will retrace by 61.8%. There's a lot of measurements to do. This is quite easy. Don't think it's difficult. This is an impulse, and it's a price will retrace by 61.8%. So let's take the Fibonacci 2 from here. You click here and drag it to this level. So this is your X and this is A. So it should retrace to 61.8%. That's what exactly we are talking before it makes the next price action. Now it moves from this point to another level, but not at the same level with the point A. This is point A here. Here is point A. All right, this is X. This is B. B has this deep retracement, 61.8%, and then it moves back to C. And this C, BC will not be up to 100% of AB, so you shouldn't go more than that. So let's check all the requirements. Let's look at the slide again. Now you can see A retraces to B about 61.8%, and B moves up here, right? It moves up here, not more than 38.2%. You can see it here of this move. Okay, so level C and A should never be on the same scale. It should not be on the same level. C and A should not be on the same scale. So you follow all these retracements. Okay, you drag from A to B and move to this point, should give you about 38.2%. All right, then market moves again from C down to D. You see, from C down to D. And this whole move from C to D should not, it should be between 127.2% to 161.8%. All right, of this whole move. All right, D has gone into extension. Okay, so if D gets to this level of B, at this point it will be 100%, but it should move down lower than this B. Okay, it's just an extension of 127.2%, but not more than 161.8%. So when all this agrees, and also the relationship between D and S should be that D will be a retracement of about 78.6% of the XA move. All right, so if you use your Fibonacci retracement tool and drag from S to A, D should be, you see B is about 61.8%, so D is about 78.6%, which means it's close, it's lower than this level. See, this is 1.8% is here, then D is lower than B, 78.6%. All right, so when it enters all these matches or fairly matches, okay, you'll be expecting a price reversal zone at point D. So a move here, D should do this, come all the way down below here, and then you can now join this and join this, okay, then join this. So this is point D, and point D usually provide us the market entry zone. Is actually a zone. All right, at this point, price is getting ready to make another impulse in the direction of the trend. The trend is bullish, so this is the bullish Gartley. when all these values, these Fibonacci retracement values are the coordinates of this X, A, B, and C. All right, this is 61.8%, okay, of this whole SA move. Here, C should be between that 8.2% and 88.9%. So it should not get up to 100% of AB. So meaning that point A and point C should not be on the same level. I hope you're getting this. And now we're saying D should be the extension of B. The extension, D should be the extension of AB, all right? If D is at this level of B is 100%, all right? But it should go lower, between 127% extension or 161.8 extension of AB. Now, the relationship between SA and XD is that D should be about 78.6% of that whole XA move. So D again should not be at the same level with X. C should not be at the same level with B, like here. So let me take another horizontal line and put at X. So D should not be at this level. It should just be about 78.6, and that's exactly, you can see 78.6 here. It's exactly here. This is 61.8. We're saying that. And then AB, if we do from A to B, this movement should be between 38.2 and 88.9. %. So at this point, all the market, you can see the market geometry is looking like this. What this particular shape, we call it Gartley based, on the name of the man who discovered it. So at the point D is a price reversal zone. Point D is price reversal zone. Okay, that's what it is called. PRZ, price reversal zone, is a point that the market will get down here and begin to journey upwards. So if you are, whenever you see this, all these conditions satisfied, okay, all these conditions are satisfied, all the coordinates are the same with this shape, this is a Gartley. If it forms exactly at these numbers, we call it a perfect Gartley because all the coordinates align with what is defined. But if it's close to it, like for instance, if the retracement from A to B forms at maybe 59%, so it's still allowable, and D comes to maybe 72% of the XA move is still allowable, meaning that it's not a perfect Gartley, it's an imperfect Gartley. Okay, if it forms in a bullish market, we call it a bullish Gartley. All right. So the target is that it helps us to identify this point D, which is a market reversal zone. And this historically has been, seen to be consistent over a period of time. So if you understand how to use it consistently, you'll be making some profit. The success rate is about 90%. So anything 90%, 9 out of 10 times it works. So it can guarantee you success in trading using this strategy. All right, so when this has formed, you move your time frame. Like I told you, if you saw it in the 1 hour time frame, you can move your time frame to 15 minutes time frame, so you can see more details of what the price is doing, in this zone, within this zone. All right. So most likely, most times price will, this is the behavior of price. Price can just come down, hit a support area, move back up, okay, return back to that support area, giving you a kind of a W formation, meaning that it has established a support level here. All right. The next is that it pushes up, break a certain level, okay, retest it. At this point, you can enter a trade. You can enter a trade from this moment, from this area, and take it, you see it moves right the way upwards. Okay, so at this point, you can enter multiple positions, maybe about 3 positions or 4 different positions, and have different profit-taking levels, You can also use the Fibonacci retracement levels to take it. But the fact is that market price will exceed, to move up, exceed this level A, where this A is, and continue to move, because this is uptrending market, so it has to continue in that direction. So what this Gartley helps you to understand is to identify, all these combinations, we're able to identify a price reversal zone at point D, and that's the area you begin to get ready to enter a trade. Because if you enter the market at this point B, price will come down lower and take you out of stop. If you had entered it at this level, it's a price push down back here and take it out of stop. So if you entered it at this point A, you will also lose the trade. You have to be patient to wait for the market price to do this geometric shape, which is called the Gartley, and of course conforming with all the various levels of retracement, and price will definitely do. Most of the times it follows this trend. So you can take the trade, enter multiple positions here, and have here as a take profit 1, take profit 2, take profit 3, and as market continues to grow, your trades will be, your profits to be locking in. All right. So if you find it the same structure with the same coordinates, Fibonacci coordinates, repeating in a downtrending market, it's called a bearish trend. So this is exactly just the inverse of this particular one. So we don't need to go into all those details. So the next type is the ABCD pattern. All right. This ABCD pattern is so simple in the sense that it's easy to identify. And remember, you have to apply it in a trending market. In a trending market, when you find it in a non-trending market environment, the chances of it working can be reduced, can be 50-50. All right. So to be on the very safe side, locate these patterns in a trending market. All right. So the ABCD pattern, very simple. Price, I'm going to illustrate. Let's move back to my trading view. I'll take this down again. Okay, right. Price makes an impulse like this. Okay, this is an impulse. It retraces from A, right, to B, and now pushes back to C. So this is A. So that's why it's called the ABCD pattern. This is A, and this point is what? B, and this is point C, and it comes down again to this point C, point D rather, providing us with another entry, point D. And now, why it's called ABCD pattern is because of the requirement. At least these are the conditions. The distance from A to B should be the same thing as the distance from C to D. All right, distance from A to B should be the same distance from C to D. But in Gartley, that's not a condition. Okay, from here to here should be the same. A, B must be equal to C, D. That's the main condition. All right. Now let's go back to the slide to check the retracement levels. See, from A to B must be the same thing as what from C to D. And the retracement, look at this, retracement of a price moves to B and pushes up. So between 61.8% and 78.6% for it to be ABCD pattern. So between 61.8%, when price moves from A to B, it should retrace to C between 61.8% or 78.6%. So you have to be sure that these coordinates, these levels of Fibonacci retracement conforms before you can call it an ABCD pattern. So the first condition is that AB must be the same distance as CD. So A to B must be the same distance as C to D. Then A to B, the retracement of BC should be around 61.8% to 78.6%. All right. Now, price moves from C to D, and this C to D should be the extension of AB. Level D should be the extension of AB. And we are saying, if this price retraces to this level of B, okay, it will be 100%. All right, it will be 100%. So there's an extension now. Price has moved, right, from this level to between 127.0% to 161.8%. All right, you can do this in decimals or in percentages. So in decimals, 1.27 to 1.618. Okay, levels of retracement. When this is complete, I tell you, market price will immediately move up in this direction. So let's go back to this is exactly what we're looking at. So this is that retracement from A to B, return to C, 61.8 and then 78.6, and it moves again from C to D, okay, which is the same distance, and which would be an extension of 127% to 161.8%. So when this happens, this D becomes a reversal, price reversal zone, an area that you should start looking for an opportunity to buy back the market in the bullish direction. So entering at this point, you would think price has moved to see, oh, maybe this AB is just one single leg correction. All these structures, A, B, C, D, is a correction, is a corrective structure, but it's a harmonic corrective structure. We call it A, B, C, D pattern. All right. So when this completes, we're ready to take a trade around this point. I can say you can enter multiple positions, depending on the size of your account. So you can enter multiple positions, maybe one or two mini lots from here, and get those Fibonacci levels again, okay, as your take profit 1, take profit 2, take profit 3, even take profit 4 positions, and you see market move all the way to be cashing in, closing you in profits as the market continues to push up. All right, so back to the slide. We have here the ABCD pattern, and we have two types of it: the bullish ABCD pattern and then the bearish ABCD pattern. Bear in mind, the bearish forms in the bearish trend, while the bullish forms in the bullish trend, in an uptrend. All right. So we move to the next slide. This next slide tells us about the bat pattern. The bat pattern looks somehow like the Gartley pattern, but not exactly. The difference, it has about the same structure, but the difference is the retracement levels, and that we're going to look at. Remember, when price will move from X to A, that's the first impulsive price action. It will move from X to A and retraces. This time it's no longer a deep retracement. In Gartley, it has retraced by 61.8% to be a perfect Gartley for you to call it a Gartley. If it does not conform to that, please ignore it. Okay, no matter how close it looks like. So, but in the BAT, the price AB will retrace by between 38.2% and not more than 50%. So if the retracement of AB is below 50%, actually between 38.2 and 50%, we are looking at, you're imagining a BAT harmonic pattern forming. So you saw an impulsive price action from S to A, and it retraces by, let's say, 50%. So it's looking like a BAT harmonic pattern is about to form. Now, B price will move from B to C, and exactly the retracements of this AB to BC should not be, it should be between that 8.2% and also 8.6%. It should not get to 100%, meaning this C should not be at the same level as A, just as simple as that. And you see price again drop below the D, enters into extension. So AB will enter into extension. So D will be an extension of AB by 168.2%, okay, between 168.2% and 261.8%. That's the recommendation for that level of retracement. And again, the D should not be on the same level with S. So D should be the retracement of XA by 81.6%. When these conditions are complete, D again, this D area forms a price reversal zone where you can begin to look for an opportunity to buy the market back. This is the bullish, okay, market moved X to A in the bullish direction, and is not correcting in this BAT pattern, following the various levels of retracement that we have pointed out here. You must measure. See, you don't need to cram these levels of retracement, but if you teach it and monitor and continue to use it, they will just become a part of you. You don't need to cram it. It's an open book. When you are trading, it's open book. You can bring out your notes, bring out everything, your plan, all your videos. You can use them, reference them to check whether they conform with this. If it conforms, you begin to look for entries at point D, which is the point that the market would be getting ready to make another impulse. And of course, you should have known now that price moves in waves. It makes an impulse and it retraces and makes a correction. And I told you at the beginning of this course that the harmonic patterns, they are correlative structures. So they form within correlative structures. The whole of A, B, C, and D is the correction of XA, all right? It's the correction of the move, the impulsive price action XA. So price made this impulse and now corrected by, you know, A to B, B to C, C to D, before it begins to move in the bullish underlying direction. So when you find this, you know, pattern form in a downtrending market, we call it the bearish bat harmonic pattern. If it forms in a bullish market, in an uptrending market, we'll call it the bullish bat harmonic pattern. All right, we'll move to the next. So the shape look the same, but the only difference is in the various levels of retracement, which you have to gauge. And I said earlier on, you don't need to cram it. You have your notes, you have these slides, just open it and check whether they conform with these various requirements. If it conforms, then that is it. You have an opportunity to trade. Now, in the bullish, in the bat pattern, sorry, in the butterfly pattern, which is the next pattern, so lovely. I like the butterfly pattern because it has a higher level of retracement. It retraces deeper than the Gatly and the bat pattern. So the price makes the first impulsive price action from X to A. It retraces so deep. You know, the bat pattern tells you that it will retrace, you know, around 50%, between 38 and 50%. In the Gatly pattern, Gatly says the requirement must be 61.8%. But the butterfly, for the butterfly pattern, is a deeper level of retracement. This time, 78.6%. So price moves up and almost returns. It almost closes down on that initial move. It almost closes down on that initial move, 78.6% at point B here. And it moves back up between 38.2 and 88.6%, not exactly at the same level with A. So you need to follow this again. And then from C, it drops back down, deeper and lower this time around than where it started. It now looks like, okay, this it's looking like is a reversal, but it's not a reversal. If you follow this very carefully and check all the coordinates, the various levels of retracement. So this time around, D will retrace about 161.8%, you know, deeper down is an extension to 261.8% extension of AB, extension of AB. So D must be lower than the point B, and this D this time around will be lower than X. In Gatly, D is above X. In BAT, D is also above the level of X. But in Butterfly, which is a deeper level of retracement, D actually comes now lower than X. When this is confirmed and is complete, and you're sure you are in the right market environment, trending market environment, either bullish or bearish, or when this forms, you begin to look at this D as an area where price has a high probability of reversing and going back to the bullish direction. And that is exactly, remember, it's a zone. It's not just a point, it's a zone. You know, you need to understand how the price will play around this zone before it begins to move up. In the Gatly pattern, I did an explanation of the possible price behaviors. Okay, and of course, if you want to know more about what happens in D, please watch our video on best entry techniques. Okay, with that in details, best entry techniques in the markets. All right, so if you find these conditions fulfilled in a bullish market, it's a bullish pattern, a bullish butterfly pattern. If it forms in a bearish market, it becomes a bearish butterfly pattern. So let's go to the next one. Oh, I like the crab. The crab pattern is the most effective. You see, all my years of training, anytime I identify this bad pattern, it has been 10 out of 10, 10 out of 10. It does not fail. If I have time in this video, I'll show you a live structure pattern of this crab. All right, look at the crab. Look at the crab. I usually will illustrate it as someone who is hunting with a catapult. Catapult, you have to draw it. When you draw it, extend it so well. The back pattern gives you more extension. It gives you more reach for your trading targets. It gives more profits. It's more accurate than any of these other ones. As I told you, all the times I've applied it is 10 out of 10. 10 out of 10. And now let's look at the coordinates. So price moves from X to A in the bullish. Of course, this is a bullish market. Price moves from X to A. That's an impulse. It retraces to be between 38.2% and 61.8%. All right. All of these retracement, they are unique. Now, between 38.2% and 61.8% to B, A to B. Now, from B to C, price moves back up, okay, in the bullish direction, but this time not getting exactly at the level of A, but that B to C should be between 38.2%, okay, retracement of AB to 88.6% retracement of the AB move, all right? Then you see price falls again. This time around, it falls so deep. This is a deep retracement. It falls so deep, lower, far lower than the X. All right, this time around, the retracement is 161.8. Is an extension. So price move from X to A and pushes down. It comes to 100 level and pushes down to 168.88% extension of XA move. When this has happened, identify point D. Point D is exactly where we are looking forward to taking our trade. So when this happens around this area, you do your setup in such a way you can monitor price action. Exactly, you move your time frame to the 15 minutes time frame and see details of price action around this. You can also look at some of the candlesticks formation that will suggest markets, price being rejected around that level. And if 15 minutes time frame, you can see some structures, support structures and some candlesticks formations around here that will suggest that markets will move. And I tell you, when it moves from this D, it moves so far up in the direction of the trend. All right, so this is the harmonic patterns. I told you it gives you up to 90% success rate, which is translated as 9 out of 10 times you use this pattern, and it makes use of a combination of market geometry and the Fibonacci retracement tool. And I find this very useful, and if it's very useful to you, like it to like this video, share it, and then subscribe to our channel so that the video can be available to other traders. I'd like to say thank you to every one of you for joining us on this channel, and we look forward to seeing you in the next video. Thank you.